apparently some of our older citizens are misbehaving. They're investing like 30-year-olds. The Wall Street Journal has a scandalous article on this. Let's talk about it. Welcome to the Mullooly Asset Show. I'm your host, Tom Mullooly, and today we're going to talk about something a little scandalous. So apparently, Vanguard and the Wall Street Journal think that older folks shouldn't be investing too heavily in stocks. There was an article, we'll link to it in the show notes, that at Vanguard, 1/5 of taxable brokerage clients, so 20% of their taxable brokerage accounts, folks that are 85 years old and above, have nearly all of their investments in stocks. We're okay with that. The tone of the article seems to be a little scandalous, like this is a bad thing. I'm not necessarily, and I don't think here at the firm, we're really all that upset with something like that. I don't personally think people take enough risk when it comes to their investments, but that's my own personal opinion. You've got to do what's right and what's comfortable for you. The article spent most of their ink talking about not having a proper allocation or balance or diversification. But I just want to zoom in on a couple of things that I think are really important. When you look at someone who's 85 years old, I know a couple of things about them. If you're 85 or if you're in your 80s, you were born between 1934 and 1942. You're in your 80s. So I know that you were born in the later part of the Depression and you grew up through World War II. The main takeaway I've got with folks in this age bracket, they're my parents' age bracket, very good at saving. They understand the value of a dollar. They know how much things cost, and they want to keep their expenses low. That's really important, things we all need to remember. So I also know that these folks have seen highs and lows in the economy and in the United States and in the stock market through many decades of experience. I also know that if you go to work with an advisor, the advisor is going to talk about you need to have proper diversification. You need to spread the risk around. That is their job. You should hear a speech from that advisor. It doesn't mean that that's right for you. You have to go with what's right for you. So the thing that wasn't mentioned in the article, which I was very disappointed, they should have brought this up, taxes. If you've owned stocks for 20, 30, maybe 50 years, you have a huge amount of unrealized capital gains. If you go to diversify this account, you're going to have a huge tax bill. I mean, a huge tax bill. And honestly, you're going to question whether it's really worth it to diversify when you're doing something like that. Why don't you just stick with what's working? It's a good question. The alternative, which I think was missed in the article, is the fact that someone in their 80s, when they pass away, the stocks that the next generation will inherit will have a stepped up cost basis. All that unrealized capital gain goes away. There are no taxes that are due with something like that. A very good reason to hang on to the stocks that you've owned for a long time. If you are in this situation, or if you've got a family member that's in this situation and you've got questions, not sure what to do, get in touch with us. We'd be happy to talk to you. That's going to wrap up this episode of the Mullooly Asset Show. Thanks again for tuning in.